Are you a plumber looking to learn how to read your profit and loss effectively? But not just for reading the profit and loss, for actually making decisions based on your numbers? I'm Tim Kraus, the operations partner at Cornerstone CPA, where we do bookkeeping for around 70 clients, 70 plus clients, and do taxes for several hundred more. So, I don't know if you know this, but out of all the businesses that fail, 82% of them fail for cash flow problems, which is by far the number one issue the businesses have. And so the point of this is so that you could learn how to read your numbers effectively by mainly looking at just three numbers on a profit and loss, so then you can see what's going on in your business and where you might need to change some things. So let's dive right in here. So, an overview of what an actual profit and loss is. This is kind of a very basic version of one here. So there are a few sections, just mechanically here. So we have the income section up here, and every black line, everything above that gets added into it. So then we have our COGS section, which is our cost of directly doing the work, which is this section right here, and all those get added up. All these numbers get added together and go into that number right there. Then we actually have our expenses section, which is like things like your office expense, basically more fixed costs than actually the more variable costs that will go in COGS, which we'll dive into that more here in a little bit. But that's kind of this section here. So primarily, spoiler alert, when I'm looking at a profit and loss, I'm going to be looking at the total income row, the gross profit row, and the gross profit margin, which is that percentage over there on the right. And then also looking at my net income and the net profit ratio, or the net profit margin right there. So one quick side note about profit and losses in general, it does not actually show the total number of dollars and cents that is actually in the business. Like you're not going to see this $5,253 in your actual bank, because that does not include actual debt service. So debt service, that will actually go to the cash flow statement, which is actually a different video that we'll get into later here. But the profit and loss shows the profit and or loss of the operations of the business. So some of the decisions you can make from this, which are really important, especially if you have them categorized separately, are evaluating which sort of jobs are more profitable, whether they are commercial or whether they are residential in this case, identifying potential rise in costs of materials or labor, which is a huge problem we're seeing for a lot of our clients right now, is that those costs are getting much higher and they're not seeing it. So their gross profit margin is going down, and then they're underbidding jobs, and it's just kind of a mess. So also we've had clients have this too, deciding when, the key word being when here, to invest in new tools, vehicles, staff. We've had clients who have got a lot of deposits and then invested them way too early, and then have now ran into actual cash flow issues, which has been a really bummer. And one of my favorite parts as an operations person is identifying the underperforming areas in the business. So let's go on to the first section here, which is actually going to be the COGS, or the cost of goods sold. So definition on what this is here. This actually means that the money that is spent in the direct, or it's called the direct labor actually. So this would be like the actual plumbing work. This would be actually buying supplies and actually paying the laborers in the field, or paying your plumbers actually in the field. In general, for plumbers, the COGS should be things like materials and supplies, your subs, your direct labor, your specific rental equipment that is actually for the job. So this would not be like computers or like the printer that you might have in your office. This would actually be like any sort of generator that you might have on a job site. And travel expenses for jobs. This also includes things like gas. But there can be some debate on what should go in a COG versus what should go in an expense. But in general, you want to have it so that when your amount of work that you do goes up, your COGS are kind of going up with it. And when the work you do goes down, the COGS are kind of going down as well. We'll explain that more on the operating expenses slide here. So the cost of goods slide, the cost of goods is cost of goods sold area, or COGS as we call it, is right in this area, and all these numbers here get added to now make this 31,000. Now something I like to have on my profit and losses is actually it's a setting in QuickBooks, but it's called the percentage of the income. So as you see here, this is 100%, And then if we go down, this actually gives all the other percentage, which gives us our gross profit margin, which we will dive into that a little more on the next slide here. According to Sharp Sheets, around 25 to 35% of your revenue should go for materials and supplies. Again, this depends on what type of plumbing you're actually doing. And then, actually, no, for the gross profit margin, it's actually, they roughly say about 50% gross profit margin, so that means probably 25% to a little bit less than that actually would then go to your actual labor. So, this you can see for this particular profit and loss, we have 32% went to supplies, which is within technically the industry average here based on Sharp Sheets for plumbers. So that's a little bit of what is COGS, what are COGS, and what they should actually contain in your books. So the gross profit margin. So the gross profit margin is the percentage of the job. It's basically your gross profit, but shown in a percentage of the total income. So if we actually look at, if we go down here and we could see, we have our total income, the $55,005, and then we have the total COGS, which is the $31,000, and then we actually have the gross profit, which is another line inside of your profit and loss, which then your gross profit is the $23,000 right up there, which then leaves your gross profit margin at 43%. Here's the actual formulas you could do if you want to do that for calculating gross profits and then actually gross profit margin. Again, if you have on the percentage of income comparison in your actual reports, it will do all that automatically, which I definitely prefer. It's good to know how they came to these numbers still, but I definitely prefer that. So according to Sharp Sheets, again, the gross profit margin for plumbers is around 40 to 60%, with an average being 55%. So this shows the efficiency of the actual production team, of the actual guys in the field, guys or girls in the field doing the plumbing. How well are they at actually doing the work? So here's some suggestions that basically, if you're above or below those sort, like, hey, if you're above that, hey, that's awesome. You could push on more growth. You might be able to put more money into marketing. One quick caveat with this that I do want to mention is that this is assuming that you have employees. That's what Sharp Sheets is assuming, that you have employees. If it's just you, your gross profit margin is going to be way higher because technically, as the owner, your wages actually go in the expenses category. They don't go in the actual cost of goods category. So just keep that in mind, because you're like, hey, I have 90% gross profit margin, or 85% gross profit margin, or 70% gross profit margin, but you're the only employee. That's not really what this is talking about here. So if you're within the benchmarks, that's good. And what I would have for myself is simply what is my normal, and then just based on my normal, go up or down from there, or know if I need to adjust it or address it or not. So, and if you're below the margins, this is where you can actually do some adjusting. So you might have supplier negotiations that you need to do. You might also need to consider ways to add efficiency to your team, and in worst case scenario, potentially actually reduce the size of your team doing the work. That is a lot more factors, but that can show this as being one issue, especially if you're having your sales go down, and then your COGS cost are staying the same. That could be a big problem. That is more painful to address, but you should definitely have an eye on it. We had a client, his gross profit margin went from 55% to 45%, and he didn't quite realize that, and then he had a pretty big issue with underbidding some jobs because he thought he had more profit. He thought he had more room than he actually did. So the operating expense, which is the next and last section of the actual profit and loss we're going to be going over here, is under the expenses bucket here, and it is all of the fixed costs. So operating expenses are the costs of running your business that are not directly related to the specific jobs, unlike your COGS. which are tied to doing the work. Operating expenses cover things that keep your business running overall. So one way to think about this is that if you technically had no jobs one day and you didn't have any of your guys out in the field working, like, you would still have to pay for utilities for your utilities. You still have to pay for any sort of vehicle repairs. You still have to pay for any sort of rent that you might have, and you would still have to pay for marketing and advertising, insurance, professional fees, supplies, and if you are an S corp, the owner's salary would also then go in here. If you're not, then that would probably just be in your net profit. But for the size of businesses where you have, 5 and above employees, very likely you should be an S corp. That's actually a different video, but this could be a good tool if you're not using it. So according to Sharpsheets, again, the benchmark for operating expenses they're saying is between 20 and 30% here. So we have our operating expenses, which is again all of these here total up into this guy right here. So that gives you your total operating expenses, and you could see for this particular hypothetical, by the way, this is not actual clients' books, these are hypothetical books here, you can see that we are technically a little bit over on our operating expenses. So maybe there is a room for improvement in there. I'm seeing right now, especially with the way the market is, especially in the car world, and even in the services world, a lot of businesses trying to help their operating expenses because things are getting a little bit tighter. So these are going to be things where you have your salary, rent, your vehicle costs, those are like repairs, your marketing, advertising, insurance, professional fees, and then office supplies and things like that. So that is what your operating expenses should look like. So now the net profit margin is simply just like with the gross profit margin. The net profit margin shows how much money your business keeps for every dollar that it earns for the operations. Again, not actually what goes in your bank. That is actually on the cash flow statement. But again, if you have the percentage of income turned on, your net profit margin is simply right here, which is one of the 3 rows that I would look at if I was looking at a profit and loss. Is I would be looking at this is one of the numbers and looking at that, especially that percentage, to see if it's changing. Again, if you would like, here are the formulas with how this is all calculated. They're pretty basic, but I again would rather have the computer do the work for me. Net profit margin for plumbers, again according to Sharpsheets, is between 10 and 15% is what you want at the bottom line. So if you are above that, if 16, 20%, 25%, hey, that's awesome. I also know plumbers have a lot of marketing expenses in there, which is, that's where reoccurring programs could kind of make sense, and really trying to build relationships and potentially adding some commercial work in there, more business to business work that is more long term than always having to find the new residential job, but I know those pay more, so there's a balancing act there. But if you have really good net profit margins, it could be very well time to expand, time to push forward, time to grow. Hey, something that you're doing or the opportunity that you have is really good, so you might as well go for it. If you're balanced margins, that's fine. That's where, again, a lot of businesses are at and do well with, but also keep in mind that with a 10% profit margin, you don't have very much room. You have to be pretty tight on when your income goes down by 10%. You want to make sure your COGS go down by 10%. So, let's do up here. If you have your income, and if your income's kind of going like this, your COGS should also be going relatively like that. And then the gap in between, that's your gross profit margin. Your operating expenses, though, are going to go more like this. Now, again, hopefully they won't just keep on going up and to the right. So the operating expenses are going to be like, this will be like a new office, this bump right here, and things like that. But generally, your operating expenses are going to be going relatively flat. Your COGS, especially if you have a 10% profit margin, you're going to want to watch those, especially your gross profit margin, when times get tough, and figure out what you have to do from there. So if I was to look at this profit and loss here and look at it relatively quickly, like I would probably do almost every month, and then maybe once a quarter dive into it deeper, I would go in and I would look at these 3 rows. I would say, okay, our income, is that within where we want to be as a business? Is that within where we're going to be growing to? And then gross profit, but also more importantly, gross profit margin, which is the percentage right over there on the right, which would really help me know, hey, are we as efficient as we need to be as a company? And then our net profit and our net profit margin. So this kind of lets you know at a high level if something's wrong in these, and we could dive in. Again, our net profit is technically a little bit below where we want it to be. So is something wrong? But like with most things, like when I worked back in the ambulance back in the day, we had to take 2 sets of vitals because one set of numbers was just one point in time. You really want to see the trend in your business, because even if Sharp Sheets or any other place has industry averages, that doesn't really affect your business a ton. It's more of what is the trajectory of your business. Are things getting better or are things getting worse? So we're going to dive into a 3-month version here, which I know looks intimidating, but this is all just the same pieces we just did, but it's all next to each other. So we have month 1, month 2, and then month 3, and then the total over here, and then the percent total, which is actually technically the percent average, but QuickBooks calls it percent total, so that's what it is right there. So with this, we can then dive in. Let's do the same thing here. So we look at month number 1. Okay, income is 55. Let's say that's within our goal here. Our gross profit margin, let's say it's 40 to 50. Okay, that's good. Let's say the materials are fine as well, because we can also divide those out separately if we wanted to. And then we would go then down to our expenses for this month, and then say, okay, operating expenses are 33%. That is a hair high, and we are a little bit low here. So that might cause me to actually look into things, or look at advertising more, or look at, actually this would tell me that the problem is likely somewhere in here, because that number is outside of what we're looking for. So then going to month number 2 here, again, our income is actually up, which is great. And then our COGS, we actually have a little bit worse of a gross profit margin, but not terrible. If you see, we got 43 to 42, so not that much of a difference. And then if we go down here, our operating expenses were only 27%, and they were 33 before, so that's doing even better. And now our actual net profit margin is 15.17%, which is awesome. So something good is there, potentially. Then let's go on to month number 3. Okay, now sales are down 44, and they were 60 before. Okay. Our gross profit margin is now down to 37, and it was 42 before. So that's not good. If we actually go to the numbers of our actual COGS, 34,027, so it did go down, but our income went down a lot more. So it compressed our gross profit margin from 42 to 37, which then correlates to 43% in our operating expenses, which is really not good, really out of whack, and negative 5% margin here. So what happened in this situation? Well, in this hypothetical situation, but I've seen this happen before, the actual big change in expenses here was from their actual, again, it's hard to see when I've got to scroll over here, their marketing and advertising went from $3,500 a month to $2,500 in this month. And then they had a big reduction in their actual total income, which then had knock-on effects, and then they increased their advertising here, and then we'll have to see the next month how it goes. But these are just some ways you can kind of look at, okay, what's going on here. And again, with this gross profit margin. It's like, hey, everything, month number 2, everything was looking rosy, looking great. But why was it looking that way? Are we going to be shooting ourselves in the foot later? Are we still staying within all of our numbers that we want to be? Is the efficiency of the team doing well? Is the efficiency of the actual office doing well? And to be fair, with some of the efficiency of the office, we could actually also look at the actual number itself, because that should be staying relatively stable. So yeah, hopefully that helped here. Here's a little bit for plumbers on how to read it. Again, 3 sections. I mainly look at 3 numbers first for starting. Your total income, your gross profit margin, and your gross profit, and then your net income and your net profit margin. Thank you very much for your time here. My name is Tim with Cornerstone CPA. We do bookkeeping, tax, and tax planning. If you'd like to learn more about us, please feel free to reach out.